Vincent Reinhart is joining us right now. He's the chief economist and macro strategist at Dreyfus and Mellon, has done a tremendous amount of research over the years about that reaction function at the Fed and spent several years working at the Fed himself. Vincent, always a pleasure to talk to you. Always great to get your insights. And I am curious here, we all seem to be obsessing over this report because there seemed to be in a couple of data points leading up to this that might have suggested that there could be an uptick, at least in certain elements of inflation. And I'm curious as to what you're expecting, what you're seeing.
Okay, obsessing is the right word because market participants focus their attention on some bright, shiny object. And over our careers, that included the release of M1 and flash GDP, neither of which exist. A lot of attention to employment. Now they've turned to the CPI. Lots of reasons to expect a less good number than the last three in a row. Part of it was revisions to the seasonal factors that we found out about last week and the weights in the CPI basket. Part of it is the fact that the good news was coming from the stabilization of commodities and goods prices that were contributing to disinflation, inflation going down. Now that they've leveled out, it's no longer pulling down the headline. So less good news. But the thing to remember is it's only one piece of the puzzle the Fed uses to frame its outlook, and its policy decisions depend on the whole outlook, not 1 month's number.
It's only one piece of the puzzle, but it's a big part of it. And we've got wholesale inflation that comes out later this week. How might that round out the picture here?
So the Fed has a narrative. Resources are taut. The economy is growing above trend. That should put pressure on wages. That will show up in the slow-moving, inertial part of inflation. What we'll find out about tomorrow is sort of the last piece in that chain. But the other pieces we've heard suggest that the forces for keeping inflation well above the Fed's goal remain in place. We gained more than 500,000 workers in January. The unemployment rate is at 3.4%. That would suggest that there will be ongoing pressures on resources. That's what the Fed will mostly be focused on. Jay Powell did his best to shake off 3 months of good news on inflation. It's harder to shake off the more in a row you get, but the narrative doesn't change.
Well, talk to us about the communication and, more importantly, how the market has responded to that communication, Vince, because this idea here that there has been a disconnect, at least in certain pockets of the market. But the market will make the argument, and when you talk to market participants, they say, well, we're looking at the same data that the Fed is looking at, or at least some amalgamation of that. Why is there the divergence?
So I thought you could detect Jay Powell at his press conference having exactly that same mental challenge. He basically said, this is our forecast. Here's what's in markets. It is what it is. One of us is going to be proven right. In one level, it's really about the small changes in monetary policy. The Fed's already raised the funds rate 4.5 points in a year. And we're talking about whether this will be another extra quarter point to the total. So in that sense, let's tone down the volume. We're talking about the finer tuning of monetary policy.
Well, that being the case, why doesn't he push back more, especially when people ask about financial conditions and this idea that it hasn't, it is looser now, and therefore the Fed should allow it to be looser. I find it curious that he'll sound hawkish during the statement, and then during the Q&A, he won't push back as much, and markets will take that and run with it.
That's exactly the price reaction we got on the Wednesday of the FOMC meeting. Reading the words led people to think the Fed was hawkish, and then the tone of what Chair Powell said was somewhat more dovish. Why? What's the phrase I associate most with Jay Powell over the last 30 years? And that is, it is what it is. This is our forecast. We believe it, but nobody should put a lot of wait and forecast. Right now, markets have a somewhat different forecast. The run of data over the next 6 months, not just the next day, will determine who's right. And, they're not making a decision on the funds rate tomorrow. They've got more data to come in by March. They'll make that informed decision.
Absolutely. I am curious, though, too, about the reliance on releasing these public forecasts. I remember when he came in as Fed chair, it was pretty well known that he didn't necessarily think highly of the dot plot. Let's just leave it like that. But we also saw over time that he found himself, for one reason or another, still wedded to sort of not only releasing it, but more importantly, talking about it at these press conferences.
Yeah, that's the great irony of sunshine, right? Jay Powell sometimes early on his tenure sounded like he wasn't even in the room when they collected the summary of economic projections. But now it really is one of their main vehicles for conveying a sense of where the committee is going. And the reason is that's all they got. I mean, that is their main vehicle. And all the caveats he will line up, that it's a group, it's a survey of individual forecasts based on different assumptions. It's not a contract. That's all true. But it tells us which way the FOMC is leaning. Yeah. And what do we know? They are leaning toward tighter policy. And in some sense, Romaine, a problem with the last appearance by Chair Powell, he was hampered by they only do the forecast every other time. Yeah. He didn't have dots to point to. Next time he will.
Next time he will. So the dot plots clearly indicate they see policy staying restrictive, whereas the market still seems to be pricing for some kind of rate cut in the second half of the year. Vincent Reinhart, you're so good at explaining economics to everyday people. I'm not clear on what needs to happen for the economy or the markets for the Fed to pivot by year end. What is the most plausible path?
Yeah, well, so we do contingency exercises all the time because nobody believes my forecast. A portfolio manager, an investor, has to look at the risks surrounding that forecast. And there's two ways I could be wrong that the funds rate isn't at 5 or 5.25 by year end. And the one is the bad way, and that is the economy rolls over into recession. It's sharper even than the Fed secretly has penciled in, and they just have to respond to a rising unemployment rate. The good way, which is probably what is mostly priced into markets, is that the last 3 months of very beneficial, virtuous disinflation continues. And the Fed doesn't need as high a nominal policy rate to deliver the same amount of restraint in real terms, nominal less inflation. So it's either bad news, a recession, or good news, immaculate disinflation. I say immaculate disinflation because, boy, when the economy is above trend, already has resources pretty taut, it's hard to see how you'll get inflation back toward the level the Fed is comfortable given their 2% goal by the end of the year.